Tonight, I'm going to make a claim that sounds outrageous until you see the machinery. If silver breaks around Friday, it won't be because the market woke up in a bad mood. It will be because a schedule hit a lever. A rules-based, price-insensitive seller can dump billions in notional exposure in a tight window, and the market will have to find liquidity the only way it knows how, lower. Before we go any further, I want you to make a mental note of one question. It's the question that separates people who get blindsided from people who stay calm. The question is, who is forced to act and when? If you can answer that, you stop reacting to candles and start reading the system. And I'm going to plant an open loop right now. Later in this video, I'll give you the simplest way to tell whether a violent drop is the start of something bigger or just the forced flow flush. No fancy indicators, no secret data. One question. Hold that. Here's the catalyst everyone keeps whispering about, but few people understand. The Bloomberg Commodity Index rebalancing window. Analysts tracking the rebalance have estimated roughly $7 billion of notional gold futures selling and roughly $7 billion in silver, over $14 billion combined, compressed into a handful of sessions. If those flows hit into thin liquidity, price doesn't negotiate. Price clears. Pause there, because that phrase explains almost every unfair move you've ever watched. Price clears. Markets aren't moral. Markets aren't democratic. Markets are clearance systems. When a large seller must sell on schedule, the market's job isn't to be kind. The market's job is to complete the transaction. So when people ask, will silver collapse on Friday? The deeper question is, has the system reached the point where forced behavior overwhelms voluntary behavior? If yes, then timing becomes scheduling, not prediction. Now let's lock in the macro context, because this isn't happening in a calm world. Reuters has reported IIF data showing global debt above $324 trillion in early 2025, and later near $338 trillion by mid-2025. In a debt-saturated system, small moves in rates become big moves in stress. When stress rises, liquidity shrinks. When liquidity shrinks, leverage snaps. And when leverage snaps, what looks like a crash is often the system deleting excess promises. If you've ever watched silver dump and thought, this makes no sense, physical demand feels strong, premiums are high, why is price falling? This is why you're watching the paper layer clear a collateral problem, not the physical layer renegotiate long-term value. Here's the theorem. Hear it like math, not drama. In a leveraged system, any large time-boxed, price-insensitive seller becomes the market, not opinion, mechanics. Combine leverage positioning, paper claims that expand beyond physical supply, and a scheduled seller with billions in notional size, and you get a downside volatility bias because the system must clear. And there's one more engineering detail that should change how you see everything. One report citing Scotiabank's analysis suggested the projected silver selling could be around 17% of open interest in a nearby silver futures contract. When a scheduled seller is that large relative to the arena where price is set, you're not watching investors decide. You're watching structure collide with leverage. Now I'm going to reveal the machine by reducing it to a fixed four-stage pattern. This matters because once you can recognize the pattern, you stop being surprised by outcomes. First, the foundation phase. A system builds credibility. It creates trusted instruments, currency, bonds, contracts, and people treat those promises like bedrock. Trust is the fuel. Second, the overextension phase. The system uses that trust as collateral. Claims expand faster than real wealth expands. It may look sophisticated, debt, derivatives, passive funds, but it's the same move, more promises on the same base. Third, the loss of control phase. A shock hits. Rates, war, supply disruption, political fracture, and interconnection turns into fragility. Everyone reaches for liquidity at the same time. The pool of buyers is thinner than the promises. Fourth, the outcome phase. The system restores order by forcing liquidation, changing rules, imposing controls, or sacrificing one corner of the market to save the whole. Prices gap, narratives flip, leverage dies. This is not a theory. It's a recurring operating system. Let me prove it quickly, because once you see it in history, you can't unsee it in the present. Take Rome. Foundation, a standardized money and legal framework. The denarius becomes trusted. Trade expands. Taxes and wages become predictable. Stability feels permanent. Overextension. Wars and political competition grow expensive. The easiest lever is the coin. Silver content is reduced while the face value is maintained. The state spends credibility like it's infinite. Loss of control. People notice the measuring stick is shrinking. Prices rise. Hoarding increases. Trust decays. The state responds with harsher extraction. Outcome, controls. In 301 AD, Diocletian issues an edict attempting to cap prices. It fails because you can't decree trust back into a debased unit. Markets go underground. Coercion expands. The system chooses force when confidence collapses. Same pattern. Now take Weimar Germany. Foundation, a functional pre-war monetary and industrial system. Savings, wages, pensions. Promises anchored to a stable unit. Planning is possible. Overextension, reparations, and fiscal strain after World War I. The state leans on monetary expansion because taxes can't cover obligations without political revolt. Time is purchased with printing. Loss of control. Currency weakens. Prices accelerate. And printing becomes the solution that worsens the problem. Occupation and a political stress intensify the feedback loop. Confidence breaks. Outcome, hyperinflation, and then reset. The unit of account disintegrates. Savings are wiped. Social trust fractures. Later, a new framework is introduced to restore credibility at the cost of old claims. Same pattern. Now take the U.S. monetary pivot and silver's 1970s blow-off. Foundation, Bretton Woods, and a dollar anchored by gold convertibility for foreign governments. The U.S. has industrial dominance and credibility, overextension, persistent deficits, and an expanding supply of dollar claims relative to gold. Paper promises grow heavier than the metal base. Loss of control, 1971. Nixon ends gold convertibility. The anchor snaps. The 1970s deliver inflation shocks and stagnation. Money's reliability weakens. Hard assets become refugees. Momentum and leverage pile into the silver trade. Outcome? The system defends itself through constraints. Margins rise. Rules tighten. Liquidation only appears when the move threatens stability. The point isn't morality. It's mechanism. Leverage is destroyed to restore order. 3 different worlds, 1 engine. Now apply the same pattern to the present, and I want you to feel how cold and identical it is. Foundation. Decades of financialization trained markets to believe liquidity is always there. Central banks backstop crises. Governments roll debt. Futures and ETFs turn commodities into click-to-trade instruments. In precious metals, paper becomes the main arena for price discovery. Most participants don't touch metal. They touch contracts. Check. Overextension. Record global debt and a system addicted to leverage. When debt is massive, rates become existential. Policymakers oscillate, tighten to fight inflation, ease to prevent cracks, tighten again when credibility slips. That uncertainty makes collateral more valuable and liquidity more fragile. In metals, leverage is gasoline. It speeds trends and makes reversals lethal. Add passive strategies, indexes that must rebalance on a schedule, and you create a non-human participant that can become the biggest seller at the worst time. Verified. Loss of control. When liquidity tightens, the market becomes a margin machine. Small declines trigger collateral calls. Risk models force de-risking. Volatility rises, and rising volatility forces more selling. Now insert the scheduled lever, the commodity index rebalance. If passive funds must sell billions in notional precious metals, exposure to match new weights, the selling isn't an opinion, it's obedience. Undeniable. Outcome. A liquidation cascade that looks like a collapse, but behaves like a clearance event. Price drops until it finds buyers who are not forced to sell. That's the secret. The bottom is not where value is. The bottom is where forced sellers are exhausted. Now let's make this usable, because information without use kills engagement. I'm going to give you a simple checklist to run before a forced flow window. Score each item in your head. Green, yellow, red. First, crowding. Is the trade crowded? You don't need hidden data. You need the vibe. Headlines screaming certainty, influencer timelines full of guaranteed moon, a market that's been one directional for weeks. Crowded trades don't crash because they're wrong. They crash because they're crowded. Second, liquidity conditions. Are rates volatile? Is the broader market risk-off? Are credit spreads widening? In a tight liquidity regime, price moves farther to clear the same flow. Third, the schedule. Is there a known event, rebalance, options expiry, futures roll that forces large participants to act regardless of price? That creates a window where fundamentals take a back seat to mechanics. Fourth, leverage sensitivity. How fast does selling amplify? If a small dip triggers a big wave, that's margin pressure. Margin pressure is the accelerant. If you remember one line, remember this. Value is slow, leverage is fast. Price is often set by the fast thing. Now, there's a trap that destroys both traders and long-term holders, and it's this. They confuse physical reality with paper price. You can have sold-out coin shops at the same time spot dumps. Not a paradox? 2 layers. One layer is physical, mining, refining, fabrication, industrial demand, bullion. Slow and constrained. One layer is paper. Futures, options, ETFs, systematic flows. Fast and levered. In the short term, the fast layer can bully the slow layer. That's why premiums can rise while spot falls. The system is showing you its layers. Verified. So what happens during the event? Here's the sequence, and I want you to listen for the moment you usually get emotionally hijacked. First, anticipation. Big players front-run the flow. Liquidity thins, spreads widen. Price may sag before the event. People then invent stories. It's often just positioning ahead of a calendar. Second, impact. The forced seller hits. Price searches for bids. If bids step back, you get air pockets. Fast moves that feel unreal. Third, margin. The air pocket triggers margin calls and risk reductions. This is where it becomes a crash. The move stops being about the original flow and becomes about second-order forced selling. Fourth, narrative flip. Headlines catch up. Sentiment turns. The crowd that was euphoric becomes convinced it's all manipulation. And then, ironically, right when the crowd is most emotional, the mechanical seller finishes. Volatility often peaks near the end of forced flow, not the beginning. Sometimes the scariest moment is the clearing moment. Now we close the open loop. The simplest way to tell whether this is something bigger or just the flush. Ask this. After the forced window ends, does selling continue without the forced seller? If the calendar catalyst is over and price still can't find bids, the problem is bigger than the schedule. But if the moment the window ends, the market stabilizes, still volatile, still ugly maybe, but stabilizing, then the move was largely mechanical. When the forced actor is gone, what happens next? That's the truth serum. Now about Friday. Fridays matter because risk desks reduce exposure into weekends and liquidity can be thinner. If a heavy rebalance session lands on a Friday, it can amplify the feeling of a sudden break. But don't fetishize one day. What matters is the window and the flow. Here's a quick timeline you can use. Around 48 hours before, spreads can widen, whipsaws can increase, and price can drift toward the expected flow. That's positioning. During the window, the tape gets weird. Moves feel exaggerated, stops get hunted. It can feel personal. It isn't. It's clearance. After the window, this is the exam. Does price start acting normal again, or does selling take on a life of its own? Now here's the systemic revelation, and it's why this topic is bigger than silver. The price of silver is a shadow cast by the global collateral machine. In a world where debt is record high and money is expensive, collateral is power. Futures are collateralized promises. When stress rises, the system demands more collateral, and participants sell what they can sell, often the most liquid instruments first. That's why even safe assets can drop in panics. They're sold to raise cash. So if you see silver fall hard, don't ask only, did silver become useless? Ask, who needed liquidity right now? That question is the adult version of market analysis. Undeniable. Now I'm going to kill 3 myths that keep people arguing with reality. Myth 1, if physical is tight, spot can't fall. Wrong layer. Spot is set in the paper arena short term. Physical tightness can show up as premiums or delivery stress, but it doesn't stop a forced futures flush in the moment. Myth 2, if it falls fast, it must be manipulation. Sometimes bad behavior exists, sure, but often the simpler answer is structure. Leverage plus a scheduled flow plus thin liquidity equals a sharp move. You don't need villains when you have incentives. Myth 3, I'll know it's over when the news gets positive. No, news is late. Tape turns first. Forced sellers finish first. Headlines come after the damage. Let me make this painfully real. A long-term holder sees a dump. They open their phone. Red everywhere. Their brain screams, I'm wrong, I'm late, I need to do something. They sell into the drop. Days later, the forced flow ends. Volatility cools, price stabilizes. Then they buy back higher because now it feels safe. That emotional round trip is how the system turns patience into damage. So here are 3 signals that often appear when the forced flow phase is exhausting. Not guarantees, signals. 1, the biggest red candle arrives after everyone is already scared. That's often capitulation, not the beginning. 2, price stops accelerating lower even as headlines get worse. That's sellers running out of ammunition. 3, you see violent bounces that get sold, then the next sell wave fails to make a meaningful new low. That failure to follow through is the market whispering that the forced actor may be finishing. And yes, the broader environment matters. If the dollar is ripping and real yields are surging, metals usually struggle. If credit tightens and risk assets dump, liquidity stress spills into everything. You don't need perfect prediction, you need respect for the regime. Now we land this with action, because a warning without a plan is just entertainment. There are 2 lanes. Pick your lane before volatility hits. Trader lane. Your job isn't to be right about silver's destiny. Your job is to survive volatility. Respect the calendar. Reduce size into known event windows. Avoid revenge trades. Accept that sometimes the best trade is no trade. If you can't say, I can be wrong and still be fine, you're too big. Insurance lane. Long-term physical or long-term unlevered exposure. Your job isn't to win the week. Your job is to avoid panic decisions during mechanical flushes. If your thesis is long, your behavior must be long. The system loves when long-term people behave short-term. That's how it harvests them. And here's the rule that applies to both lanes. Stop worshiping certainty. Certainty is how crowds justify leverage. If your plan requires the market to behave calmly, your plan is fragile. Now I want one sentence from you in the comments because it tells me where the audience is positioned. Which phase do you think we're in right now? Foundation, overextension, loss of control, or outcome, and why? And add your lane, trader, or insurance. Keep it simple. I read them. Final warning. This time is different is the most expensive phrase in markets. Rome had legions. Weimar had industry. The US had Bretton Woods. The pattern still executed. Overextension always demands a clearing event. One more open loop before we end. In the next video, I'll show you how the same 4-stage pattern is visible inside the commodity index itself, why certain weight changes repeat, and how that creates predictable stress points across multiple markets, not just silver. If you want to understand what comes after the flush, how the paper metals market actually sets price, how rebalancing flows interact with open interest and volatility, and what the next stage of the pattern looks like, subscribe and watch the next video. Because the machine doesn't care what you believe. It cares what the rule says, and when the rule says sell, the system sells.